So today we're talking about specifically the XIRR calculation, and specifically how you can use the XIRR Excel formula to build and run waterfall calculations. So before we dive in, let me just explain some of that stuff. If you're unfamiliar, a waterfall is the calculation or the methodology in which you take the stream of cash flows from a deal and calculate out a preferred return and promote splits, et cetera. And you can make it whatever you want, right? There's no set way. Obviously, there's industry standards, but you can build it however you want, and you can construct a deal structure however you want. Today, we'll be focusing on kind of more so the industry standard. So I will first pull up our XIRR Waterfall module. And let me just share my screen. So, and the reason why I call it a module is because it's not a standalone model. Because what you see in front of you here is lacking any sort of return calculations or assumptions or anything like that. This is just simply a waterfall. Looks complicated, but I'll explain, and it's actually pretty straightforward. But again, the reason why it's a module and not a model is because there's no sort of pro forma that produces these cash flows. The cash flows have to be put in here, and you can get those from a different model. So this is actually a great tool. And if you want access to this tool, I should mention you can do so. Let me actually just grab it for you, make it even easier. It is in this link. So we've got, this is our Dropbox link, which has our underwriting model, has this XIRR module, and is this exact document that I'm using here. So as I was saying, you can drop in any cash flows that you want and assign any dates that you want to those cash flows, and that will produce a simple IRR calculation. And that's just how XIRR works. Very simple, super useful, great Microsoft Excel calculation. However, for the purposes of a waterfall, we need to do a little bit more work. And that's where we've built out this module, which looks very similar to the waterfall that we have in our underwriting model. And I'll actually pull that up as well, just so that we can compare the two, and you can have an understanding of kind of the differences and the use cases. So I'm going to quickly reshare. So you can see this is our underwriting model. And in our underwriting model, we have something very similar here, which is this waterfall, right? However, this is not an XIRR waterfall or calculation because there's no dates. There's just simple years. So it's not as accurate per se, but of course, these are underwriting projections. So we're not actually trying to predict the future to the day, for example, which means just the regular IRR calculation is sufficient. However, with XIRR, we have the luxury of being able to assign dates to every cash flow, so we can be accurate to the day as it relates to these actual calculations. And when we do run a deal distributions through this through our waterfall, of course, we have an investor portal that runs these calculations, but personally, I don't really want to trust the black box of that software, and you can't beat Excel. So I like to, we certainly run all these calculations in our own spreadsheets like this that you see in front of you here, even just to double check the work, right? So kind of just the differences, right? This is you can use simple IRR when you're just projecting out future cash flows and you want to project out future IRRs and then run the IRR projections through a waterfall. So for example, I'm sure some of you guys have seen this before, but just to refresh, the way that this waterfall works, this is kind of a very standard waterfall. You have your generic gross cash flows that are calculated here, net cash flows for distribution. And I know it's not easy to picture when there's not real numbers here. but just bear with me. We'll get into real numbers in a second. So from here, you take the gross cash flows and then you actually run it through the waterfall. And the first part of a traditional waterfall is the preferred return. And in a preferred return, in an institutional preferred return, there's a return of capital component, right? So investors are typically owed like an 8% preferred return, and it's compounding over time. And then they need to get their preferred return back plus their original investment. And that satisfies the tier one, this tier here of the waterfall. And then any remaining distributions are then flowed down to tier two, which is where your first promote takes place. So you might have a 70-30 or an 80-20 profit split, or a 20 or 30% promote, and that will be paid out to the sponsor, or calculated to be paid out to sponsor in tier two. And then, you can have as many tiers as you want, but commonly there's, a tier two and maybe a tier three. And in tier three, for example, you could have a 50-50 split or a 60-40 split, and that will take place on any remaining cash flows that didn't get distributed up to a certain IRR hurdle in this tier, right? So this waterfall structure doesn't change from IRR to XIRR. Again, the only thing that changes are the date components. And the date components are really only useful when you have actual cash flows. Using XIRR is not that great when you're just doing projections. Is it really that valuable to be accurate to the day when you're projecting? In my opinion, no. But obviously, when you're using real cash flows, you absolutely have to have this correct, because the IRR calculation does actually change based on the day. Even though IRR, technically speaking, is an annual compounding calculation, every day does affect that annual. It's an annualized compounding, but every day it is affected on a daily basis. So that's why the date here is relevant. Okay, so hopefully that kind of sets the stage and explains what we're looking at. And again, just as a reminder, this spreadsheet here is capable of, you can plug in the promote structure. So you could say, okay, we want to do an 8 pref, and here we have 4 tiers to play with. So you could do more stuff. So you could do a more complicated, if you so choose, you could do a more complicated waterfall. You could, for example, do an 8 pref, which of course, if a pref is in place, then there's no promote. That's the definition of a pref. All those returns are first owed to the investor. And then let's say up to a 12% IRR. So between 8 to 12, let's say there's a 20% promote. And then from between 12 to 14, there's a 30% promote. And then, above 14, there's a 40% promote, something like that, right? And you can do whatever you want. You could also make it really simple, and you could just do 8, and then you could do like 8, then 15, then anything above 15 could be 50, and like that. So this actually is our typical waterfall. Except let me fix that. So our typical waterfall is an 8 pref, right? So no promote because it's an 8 pref. And then between 8 to 15, there's a 30% promote. Then anything above 15 is a 50% promote. So that's pretty standard for a syndication in the industry. And then this would allow you to then take the dates for the deal and then take the cash flows for the deal. So let's, for example, let's say, at the start of 2020, let's say we had a deal where we invested $1 million. And then let's say in June of 2020, we had a distribution of $40,000. Or let's do $40,000. And then again, in January, we have another distribution of $40,000. And then let's say we end up selling the deal on January 1st of 2022. So 2 years later, we sell the deal and we get the original investment back, and let's say some profits as well. So let's say, 1.4 million. So it's a pretty good deal. Not that good of a deal, but this deal, right? So this very basic stream of cash flows based on these dates is a 22.6% gross IRR. And from there, the calculations on the waterfall are, just the same as back in this underwriting model that I'm sure many of you are familiar with. But you can see, we can skip the tier 1 hurdle because they're effectively tier 1 and tier 2 are the same. I just simplified it down. But if you look at tier 2, you can see that we're getting an 8% IRR to investors, which requires first, of course, giving all the cash flow to investors, then returning their capital plus 78,000. And that's what delivers an 8% compounded return to investors. However, there's an additional $320,000 remaining from the gross cash flows, right? So those get to flow down to the next tier. 320,000, that is, right? And in this tier, investors are owed a 15% IRR, right? And there's a 70-30 split up to that 15. And so you can see the sponsor actually takes a bite out of the $320,000 available, a 30% bite to be exact, right? So the promote there that's taken is $63,000. And then there's still, to satisfy the 15% return, is $148,000. And then the promote is paid, right? So between those two, there's still $109,000 remaining, which then gets to flow to the final tier, which again is that 50% promote tier, or simply a 50-50 split between the sponsor and the investor. And there you can see that the $109,000 is just split 50-50 in that final tier. And that's all there is to do that there. And so what we could do here is, let's say, the $1 million investment, let's say the sponsor invested 100,000 and the LPs invested $1 million, right? You can see the final summary. The investor IRR is 17.5. You can see that's how that turned out. And the sponsor invested 100,000. So they get their pro rata share of the investment plus the promote at the end. So if you blend the promote plus their LP investment, essentially, it's a 61.6% IRR. In my opinion, this is not that informative, right? Because you're conflating promote and investment. And those are two separate things. It's good for the sponsor to invest, of course, but those are two different returns. One is, essentially active income, it's performance-based compensation, and the other is their investment. The sponsor is investing and they're essentially getting the same return as the LP, which is this 17.5% IRR. So definitely interesting to see the 22.6% gross return, right? And then flow through the waterfall, and then investors are netting 17.5%. And that's why we talk about net IRR to investor, right? It's typically speaking, people don't go out to their investors and say, oh yeah, this deal's a 22.6% IRR, right? Because most of the time investors are thinking of net, and they're thinking about, okay, well, that's great, but how much do I get, right? But what's interesting about that actually is when it comes to institutional investors and very sophisticated investors, like private equity firms and family offices, they more so think about the gross IRR, which would be here, right? Because they want to know what the base deal looks like. And they also aren't going to just accept your, general waterfall, right? They want to propose the terms and then negotiate from there. So that's why when you're dealing with a private equity firm, for example, all the conversations will be centered around the gross returns, or the gross IRR, the gross equity multiple, and not the net returns, because they don't really care about what you're proposing. They know what their waterfall, they know what their typical promote structure that they're willing to pay. So when they're running their waterfall or their calculations on their side of things, right, they're taking the gross projections and running it through their waterfall, and they're solving for their net returns. At the end of the day, everyone is solving for net returns, but the way that they get there is a little bit different as far as the starting point. Okay, before we move on, does anybody have any questions about anything? the regular IRR waterfall or the XIRR waterfall as well.
Yeah, I got a quick question. So would you say for underwriting and projecting the yearly works, and would you use this XIRR tool more as an asset management tool?
Yeah,
For
that's
tracking
exactly right. And just to clarify, yes, annual, just simple IRR, in my opinion, is sufficient for underwriting. But with that being said, you still want to have a monthly pro forma, right? So you want to run your calculation. It's just more accurate to be able to project out your pro forma on a monthly basis. But then when it comes to your waterfall and your IRR calculation, you just roll that up into annual cash flows and then plug those annual cash flows into your IRR. And then, like you said, for asset management, when you're running, whether it be hypothetical sale scenarios, or you have a refi situation or a sale and you're actually making distributions upon a sale, that's when you'll run XIRR. And you know, a well-constructed joint venture agreement will actually stipulate that the returns are calculated based on a Microsoft Excel XIRR calculation. So there's no gray area or ambiguity about how you're deriving the promote and the returns.
Is there a gross cash flow return number that you look at that you automatically say, no, that doesn't make sense? Or yes, it does make sense. Let's pursue it a little further.
As in too low, or
Yeah, precisely.
it varies based on the risk of the deal and the profile of the deal. So it can vary, but I would say like definitely anything lower than 18 is a big struggle.
Gotcha. Thank
Yeah.
you. Makes sense.
Yeah, because if you have an 18, and that's before fees, and then you have to incorporate your sponsor fees, and then also the promote, you're going to be looking at, depending on the waterfall, somewhere around a 14% return for investors, and that's on the absolute low end for what we feel comfortable offering our investors or projecting out for our investors, because our investors are typically looking for 15-16% returns, which we'd love to have investors who were more so looking for 10-12% returns, but most private capital is seeking a little bit more risk and a little bit more reward than more of like an institutional level return profile of like a 10% return.
Thank you.
Cool. Okay. So this pretty much covers the meat of the situation. I was going to share a recent refi that we did, where we actually, this is how we actually ran it internally on the asset management side of things. Let me actually go full screen. So we tracked the day the investment was made. We invested $5,250,000 into the deal, and then we had cash flows along the way, and then we had a refi, and then I ran a hypothetical calculation of, okay, well, what if we sold the deal instead of refied at the appraised value? And then that's where we came up with, I believe, this 36% IRR it was. But I just wrote up a case study on that deal. We sent out an email this week about that case study for this deal. So if you're interested, you can you probably got an email about it. You can head to our website. But yeah, no, now that I'm thinking about it, this is not, I pretty much explained everything I wanted to explain without going into this example, but just to show you, this is actually how we did it internally to run these numbers and, run these hypotheticals as well as legitimate sale calculations. Yeah, so that pretty much wraps it up. Quick topic for you guys this time. Happy to stay on and answer any questions about this or anything else related.
Can we go over that example that you had where you refied it, or did you guys already go over that?
I have a case study or we have a case study that we published on it. So I'm happy to share more details on that case study. I can pull that up.
Yeah, perfect.
Okay, cool. Also, we got a chat come in. How do we get the case study? Yeah, so I'll just pop the case study in the a Dropbox link, but you can get this full Lone Star data room here, lscdd.com. So if you go to lscdd.com, you can get this full data room here, which has our company presentation, track record, case studies, and everything. But I'll also just share the link here for this. Okay, so I'll just run through this real quick since we have extra time.
Yeah,
But yeah, we had this recent refi occur on the landing at Pinewood Park, which is a 228 unit Class C deal we bought in April of 2021. So, and we refied, just before the 2-year ownership mark. So we refied a couple months ago. So we bought the deal at a little bit less than 46,000 per unit, which is great pricing. We felt really good about that basis. And you can see, 22.4 months was the actual time from acquisition to refi. And so the return calculations here are, I don't want to say misleading, but they're not actual, because it's a hypothetical, and that's why it's implied and not realized, because we didn't actually sell the deal. We still own the deal today, but this case study is highlighting the refi, not the sale. So like I mentioned earlier, these numbers are based on the appraised value in connection with the refi, right? So if we were to have instead able to sell rather than refi at that value, these would be the returns: 36% IRR, 1.79x equity multiple. And then the cash on cash is realized, right? It's not an implied cash on cash. We have actually legitimately been cash flowing, producing cash flow during the 22.4 month hold period. So just to go over the projected versus actual, we projected 21.4. Maybe I can make this bigger for you guys as well. Is this better or is this too big?
Better. It's a lot better.
Okay. So the, we projected over a 5-year period, as you can see here. So the reality with a short hold period, again, of 22.4 months is it's going to inflate IRR, because obviously the time value of money, you get a bigger IRR over shorter periods of time. However, because it's only been 22.4 months, the implied equity multiple is less than the projected equity multiple over 5 years. Because of course, if you have 5 years of growth, 5 years of appreciation, you can expect, a bigger equity multiple. And this is why one metric is not sufficient, right? If you only speak in IRR, it cannot be sufficient. And that's why people talk about the fact that you can't eat IRR, and that, it's great to have a big IRR, but if it's only a 14-month hold period and you actually only, have a 1.2x equity multiple, it's really not that exciting. So, so that's kind of how these different projections work together. Also, the cash on cash, with more time on your hands, usually cash on cash grows over time, which allows you over a longer period to have a higher cash on cash than a shorter period. In this situation as well, when we acquired the property, we assumed the seller's existing loan, which was in place since 2016. So it was kind of an aging existing loan that had been amortizing for a few years. So there was no interest only, and the amortization schedule was actually more aggressive than your typical 30-year, right? So that's going to hurt cash flow. So in the earlier, couple years and of the project, cash flow is certainly much more difficult to achieve when you don't have interest only and don't have the luxury of time. So that's kind of the highlights and the return factors. The actual nuts and bolts of the deal, this deal was owned by a local owner in Lubbock, Texas, which is a secondary market. It's the 11th largest city in Texas. So it's not a small city, but it's still definitely a secondary market to the major players like Dallas and Houston. With that being said, there was a lot of upside as far as occupancy and rents were concerned at this property. So our plan was to improve curb appeal and improve leasing through really not a very capital intensive project. We didn't have plans to completely renovate the interiors and blow it out. We had a modest plan as far as adding value to the property and push rents ever so slightly. The value was certainly in bringing up occupancy and tightening up the operations. And so we were able to implement the business plan, and the benefit of this opportunity was the loan assumption, which I really liked about the deal, because the deal wasn't in trouble or anything, but it was certainly below 90% occupancy, right? And typically when you're buying a value add deal like this, you would need to put on a bridge loan. And a bridge loan would be more expensive. A bridge loan would be more risk because it's shorter in maturity. And of course, it's floating rate typically. And luckily, we were able to avoid those factors by assuming the existing loan, which wasn't at a very high. It was at modest leverage. So we could have maybe potentially achieved bigger returns through a more levered loan structure. But this really mitigated our risk, right? Because we were buying a deal that had some risk to it. We were able to kind of counteract some of that property level risk with a lower risk debt strategy. So yeah, just to reiterate, this is the business plan. We improved curb appeal. We did some kind of minor strategic renovations on the interiors. We built out a model unit, which the property lacked. We upgraded the exteriors through enhanced amenities like an outdoor kitchen, lighting improvements, and then we repurposed the basketball court, which was great. So pretty standard business plan, just under $1 million spent on the property.
How'd you guys fund the improvements? Was it through your own capital? Did you guys get additional proceeds from any type of loans?
Yeah, I was actually going to bring that up. Good question. It was all out of equity. So we raised that additional equity for the improvements. So, the leverage was quite low when you factor in the debt to our, down payment or the value there, and then plus the CapEx financed out of equity. So again, that reduces risk as well. And here you can see our underwriting was pretty spot on as far as our projected rents. They were also modest too. We recognized that we weren't in high flying Dallas or Houston, that Lubbock is more of a stable market, which was great too, because during COVID, rents continued to rise. Whereas, some other markets throughout the country, like hotter ones, some rents fell. So with these projections here, we were able to, pretty much achieve rents in line with our projections. And then, as I mentioned before, we executed a cash out refi at the end of March, so a little under the 2-year hold period. And the appraised value was 16.6 or almost 73,000 per unit. And we were able to return back 50% of investor capital. With that being said, though, we had an outstanding preferred return that we needed to catch up with our investors, because our preferred return is cumulative, of course, and compounding. So while we were making, 2, 3, 4, 5%, 6% cash distributions every month, that's below our 8% preferred return. So that delta accrues and compounds. So investors were earning 8% on the amount of pref that they weren't being paid. So upon this cash out refi, we were able to catch up fully on the outstanding preferred return, which was about 7%, which equated to about 7% of the original investor capital. And then the remaining portion of the cash out refi, which is 43% of the investor's original capital, we were actually able to pay back and pay down their capital account. And also we were able to put in place, of course, a new loan with interest only and a fresh 10 years of term. So really reducing risk in a lot of factors, right? The interest only helps us maximize cash flow. The fresh 10 years of term pretty much eliminates maturity risk, at least near-term maturity risk. So if we go into a recession in the next year, we're not battling a looming maturity and having to deal with debt, because obviously that's what we want to avoid most, is having to deal with a forced refi or a maturity or something like that at exactly the wrong time when cash flow potentially could be weaker or the capital markets are tighter. Last thing to highlight is, again, this was a 5-year business plan that we underwrote when we acquired the property in 2021. So we had essentially forecasted to exit the property in April of 2026. Our hope is still to be able to probably exit the deal sooner than this. Of course, depending on market conditions, certainly right now, we don't think it's a good time to sell. It's a weird market right now. It's not a good time to buy. It's not a good time to sell. It's just a choppy market. But we did project to sell in April of 2026 for about $16 million, which is roughly in line or, a little bit less than the appraised value that the March 2023 refi that just happened, they'd appraised at, right? So we still feel confident in being able to achieve our business plan in spite of everything that, this deal already has been through with COVID and this most recent kind of weird market that we're in, and whatever recession we may go through coming up. So we've kind of taken the conservative route and protected investor capital first and foremost, and we felt that we're doing a cash out refi and returning investor capital today through a refi rather than a sale would be the best way to protect investors as well as optimize returns long term. But with that in mind, we still are optimistic that we'll be able to meet our business plan goals of selling the property and achieving our projected returns at some point down the road. And that is the case study. So if you have any questions, let me know. Also, I'm going to take this opportunity, because I never do it, to do some sales pitches. So our typical sales pitch, we've got, if you're interested in kind of learning more about underwriting, you can head to the Underwriting Multifamily.com, and you can get our underwriting book. Also, our newest book is called Structuring and Raising Debt and Equity for Real Estate, and that kind of takes a deeper dive into debt and equity structures, which includes kind of the waterfalls as well as different types of loans and debt structures. So feel free to take a look at those excellent resources. And also, most excitingly, we have our upcoming LSC Summit, which we are hosting for the 3rd time. We'll be here in New York, here at the One World Trade Center on October 16 and 17. So we're selling tickets now. We are probably going to sell out within the next month or so. So definitely look forward to seeing you guys there. We've got Ray Hightower in the house here. He was the winner of the deal pitch last year. So that was very exciting. And we hope to have some great deal pitches coming up this year. We've, as always, have some great speakers. So yeah, go ahead and check out the website, lscsummit.com, and you can learn more there.
First of all, thank you very much for doing this. I just had one question regarding the IRR and promote structure from the original module. I think the example that you had the same, had like 8% IRR for both tier 1, tier 2. What, if anything, with respect to the transaction would, you said that's kind of a typical structure, would maybe increase either one of those, from what you have as your standard example, if you will?
Yeah. Yeah. The two factors there would be the type of capital partner as well as the type of deal. So if you're doing a deal that is higher risk, and that could be just asset class specific or strategy, right? So a development deal will have a higher pref because investors want to be compensated for taking the additional risk associated with the development. So instead of an 8 pref, it could be a 10 pref, right? Similarly, like I said, it depends on the type of capital partner. So in a syndication where there's one sponsor and then there's 100 investors, the typical way things go is the sponsor puts together their deal, puts together their PPM, pitches the deal to their investors, and it's kind of like a take it or leave it scenario. Whereas when you're doing more of a joint venture with a family office or a private equity firm, the sponsor doesn't approach the capital partner and say, all right, take it or leave it. This is my deal structure, right? Instead, usually the equity is actually the one to propose the structure first. And then from there, it's just a negotiation back and forth to arrive at what is most often a more expensive or more favorable waterfall to the capital, right? Obviously, they're getting a bulk discount at the end of the day, right? If a private equity firm is providing a single check for 10 million, they're going to get a bulk discount amongst other things, rather than 100 investors investing 100,000. So again, it could be a 9 pref, a 10 pref instead of an 8, and then all sorts of different waterfalls that you see with instead of a 30% promote, it could be 20 or 25. With in my experience and opinion, I like to keep it as simple as possible when it comes to the deal structure. So that way it's just easier to explain to investors and it's not confusing. But you'll see sometimes more complex waterfalls with institutional investors. One, because obviously it's not a problem for them to understand. And number two, they like the tiered structure of compensation, right? They're fine paying more as long as they're earning more, right? If they're earning a 14 IRR, 16 IRR, 18 IRR, then they can continue to share more of the upside with the sponsor.
Thank you very much.
Yep, no problem.
Rob, is there a model or breakdown that you have that builds up the sponsor return in terms of the base return plus the promote?
Well, yeah, in both of the module and model, right? The waterfall shows the sponsor compensation at the bottom. And I kind of highlighted earlier today that it's kind of a conflation where you've got your promote rolled into the sponsor LP return essentially. So in my opinion, it's not that meaningful, but yeah, no, it is there. And I'll share, I'll go back to this real quick and I'll just show it here. Right, here's where that is. And it's this cell right here that's doing the conflating. It's showing not just the sponsor's return on their investment, but also their promote. So if you want to actually see their promote, what you would do is you'd say, okay, how about the sponsor invests nothing? And then you can see that the promote is here 118,000, right? Assuming they invest nothing, then their return is solely from promote, and there it is, promote on its own,